Hey, everybody. Welcome to the All-Star Options Jam session. I'm your boy, Sean McLaughlin. Today is May 30th, 2024. And there we go. I had to mute that thing. We'll work out that bug there. Today's May 30th, 2024. I'm back in the home office. Last week we were in Sonoma. That was a great time hanging out with some of you, some of our clients, some of our special analyst friends that we know. It was a really great time, but I'm happy to be home, happy to be back in the driver's seat here. And look, the markets have some stuff for us to pay attention to. So let's get into that. But before we do any charts here, I have to drop the old disclaimer here that everything we discuss is for educational purposes only. I'm showing you what I'm doing with my money, and I hope that you learn something along the way. All right. So for those of you who are new here in the All-Star Options Jam session, we review action that may have happened in some open positions that we have on the books in the past week. Any exits, whether for a stop or whether for a loss or for a profit, any adjustments we may have made. We will also update some stops on some existing positions, and we'll talk about some new trades that we've put on since we last spoke. And if you guys have any questions, I will be monitoring the chat there in YouTube. I'll do my best to monitor the chat, so pop in there if you have any questions. Happy to address them if I can. So let's start at the top here. Let's start at the S&P 500. This is what we're looking at right here. We've had a little bit of a pullback. We had this big red candle last week that was ominous, right? And then the next 2 or 3 trading days made us think, okay, maybe that was just a one-off. Maybe that was just blip in the radar. But then we had the earnings. Salesforce last night that spooked the market a little bit, and now we're trading a little bit lower below that big red candle day from early last week. So things to be paying attention to. I'm not sitting here. I'm not going to call the top here in the market. That's not the game I'm willing to play. But it is concerning, and it is being reflected in many of our open positions that we have on. We have seen some pullbacks in a lot of open positions. And so, look, we got to be careful out there. I added a short trade today. I may add another short trade this week just to kind of balance the portfolio out. It's always good to have some diversification in the portfolio, if nothing else. And we'll talk about one of the trades we put on to diversify. But S&P 500, it's not an all clear signal that we have here. The bull market, the bull market is still technically intact, but there is reason for concern here. Let's bring up the VIX chart also. One thing about the VIX I want to point out is, there we go, is while we're off the lows here that we had last week, one thing that was interesting is that these as I guess it was May 21st, that closing price for the VIX, that was the lowest closing price in VIX since the pandemic, since before the pandemic. That's not insignificant, right? We've come a long way since 2020. The market has digested a lot, it's processed a lot, and VIX below the lowest levels we've seen since the pandemic started. That's meaningful. So while the S&P 500 might be flashing some potential warning signs here, I mean, we're just 4 or 5 days removed from a multi-year low in VIX. So again, I'm not going to sit here and say that it's time to get short the market, that the top is in and all the money's going to be made on the downside or we're heading for a crash. I'm not saying that. But there's interesting things going on out there, interesting things afoot. All right, let's talk about some action we've had in the portfolio this past week, and it hasn't really been a whole lot. In fact, let's just start with NVIDIA. We talked about that during the last jam session because we were getting pretty close to closing out, and we did stop out of NVIDIA. We had an iron condor on. Look, I made the bet that NVIDIA was going to hold this range coming out of earnings, and I was wrong. But that's okay, right? I had a defined risk bet on. I had a defined risk trade. The notable part of this iron condor is that we were short the 111 calls, the 1100 calls. I'm sorry, the 1100 calls strike. That was the strike we were short. But our stop was 1,000. If we broke above a clean 1,000, that would be our signal to exit. And sure enough, on the 23rd, this was the first trading day following earnings. We traded above 1,000, and my process is, especially on a defined risk trade, I want to wait for the closing price, see where it closes, and if it closes below my stop, or in this case above my stop, then I'll exit on the next trading day. And that's exactly what I did. We closed above 1,100 on that first day. So the second day on the 24th, which was Friday, I believe. Yep, Friday, we closed the position. And considering the move that NVIDIA had, the loss wasn't all that terrible, right? We collected 270 on day one when we got into this iron condor. We paid 569 on the way out. That spread could have been worth as much as 20 bucks. That spread could have cost us as much as $20 to exit, but we only had to pay 569 to exit. So all things considered, not a terrible loss, a loss nonetheless. And I'm glad we followed our plan, right? Because I mean, we'd be suffering even more pain now had we not exited on Friday. All right, next up is AIG. This is a trade that, boy, just did not work for us, and it did not work quickly, which is the good news. We got into some January 2026 calls. This was, hey, we thought we were in for a long ride here. We got in because there was, the calls were priced very cheaply in terms of volatility, and it just seemed like a compelling idea. We paid $450 for those calls back on, I think it was the 17th or maybe the 16th. But we had a nice big gap down here, gapped in our face. Our stop loss level was 4. We had a close below 4 on the 23rd. We exited it on Friday. But hey, we got out for 110, right? All things considered, we paid $1.50 for them, got out at 110. We'll take those kind of losses all day long. And that's the good thing about a loss happening quick. So we're out of IAG, and those are the only 2 trades we've exited or made any adjustments on since last week. So we're out of NVIDIA, we're out of AIG. So let's get into some of our updated stops. Now, we don't have a whole lot of updated stops either, and that makes sense because with the pullback we're seeing in the market, a lot of the trends we've been riding, they've paused, maybe they've pulled back a little bit. So we haven't had good opportunities to really raise any of our stops, but let's go through them in no particular order. Some stops that we did raise. The first one is Tesla. We're long a January 200, 300 bull call spread. We got into this one a few weeks ago. We are now moving our stop up below just below the May 10th low. You can see here that corresponds to 168. So 168 is my stop now in Tesla. If we lose 168, if we lose this level of support from earlier in May, I don't like the trade anymore. Yeah. My thesis is wrong. At least in my time frame, I feel like my thesis is wrong for below 168. All right, Ego. This is the Eldorado Gold Corporation. We are updating our stop, excuse me. We updated our stop to 15. It was previously at 14, I believe. We're moving it up to 15. That corresponds with the rising 50-day moving average. If Eldorado is below its 50-period moving average, I don't want to be in it anymore. We've already sold half of our position at more than a double. So we've already locked in some profits here, which is great. The worst case scenario here is we walk away with a small profit. Obviously, we want more. We're holding out for more. We're long the September 15 calls that we paid $1.24 back in mid-March. We sold half of them at 260. So like I said, we've already locked in some profits. Let's go. Let's hold this level. If we stay above 15, we're gonna hold on. We're gonna keep this Ego trade. Lastly, FXI. FXI is a trade that was, 2 weeks ago, I was very excited about this one. We had this tremendous rally off the 50-period moving average right when we got our third piece. According to our plan, we wanted to leg into this trade, and we did. We bought the January 26 calls at $2, some more at 175, and a third piece at 150, completing our position. And soon after we got filled, the rally took hold, and boy, as recently as 2 weeks ago, this trade was looking great. We've had a nice significant pullback now. And so I'm raising my stop. I don't want this thing to give back any more. 2650 is the level I'm watching. All right. So if we get below 2650 and get into this gap that happened in early May, I don't like to trade anymore. I feel like maybe all the steam has come out of this thing. So below 2650, I will be out of FXI. Frank, I'm glad you're learning to raise your stops. It's something I've learned along the way. And let's go on a little riff on that for a second. Thanks for bringing this up, freely, excuse me. When I first started All Star Options 6 years ago, we would put the trades on, we'd have our stop, and that was it, right? We didn't make any adjustments along the way. We didn't make any course corrections along the way. Didn't lock in profits when we had them. And after doing a good thorough portfolio review or trading review over the past 4, 5, 6 years, I looked at my performance and I said, hey, I would have done a lot better overall had I been a little bit more aggressive in trailing stops in some of my winning positions. Yeah, there were some examples of where if I raised a stop, I would have gotten stopped out prematurely and then missed out on the next leg higher. Sure, that will happen. That's a risk of happening. And going back in my old trades, had I raised my stops, I would have missed some of those profits. But in total, when you look at all the trades, it would have been a noticeable improvement on my performance had I raised stops on many of my other winning trades. So that's something I've made a conscious effort over the past 6 to 12 months to be a little bit more mindful of raising stops. And that's part of the process now. We do this every week. We also have talked in the past about how I'm trying to hold winning trades longer. I know like those two things kind of seem like they're at odds with each other, but trust me, they're not. They're related, but they're not at odds with each other. But when I do have a winning trade, I do want to hold it longer. I want to, have the stock or the position or the ETF go further before I take some off or take half off or whatever. But yeah, I'm glad hey, Frey, I'm glad that, you're getting something out of this. I'm glad that you're learning to raise stops and be more proactive in your position. I think that's an exercise that will be very fruitful for you going forward. All right. Last up, let's talk about some new trades since we've last spoke. I'm not going to get into the full details of these trades as always. If you want access to detailed trading plans of every one of the trades that we do in All Star Options, simply go to allstarcharts.com, go to the members section, go to the options section, and there you will find detailed blog posts for every one of these trades that we put on. Talk about why we get into them, which type of trade we're going to use, where our stops are, where we will take profits, and anything else you might need to know about that trade so that you can take it and manage it going forward. But quickly, let's go through the new trades. CNX, we got into a bullish trade in CNX. We're liking this breakout here. We think this thing might just be getting started. So keep an eye on CNX. That's a pipeline play. We got short Nike. Nike, I like this short because, the trend is clearly down. The last two earnings reports, here was an earnings report gap lower here. Here was an earnings report gap lower here. So the last two earnings reports have not been good to Nike. Nike has earnings report coming up again in early July. And the bet we're making is that Nike is not going to fare well coming out of its earnings report. However, I can be wrong, and I am fully prepared to be wrong. I've got a defined risk trade on here. And if nothing else, and actually this was a big part of why I like this trade, is it's a portfolio diversifier. We talked earlier about how the market is showing some mixed signals here, right? The bull market is potentially signaling that it's done for now, at least, over the next couple of months. Maybe we're due for a pause. If so, if the market's going to roll over, stocks like Nike, setups are, charts that look like this, those are likely to be the stocks that are going to lead us lower. So if nothing else, being short Nike here is a little bit of a portfolio hedge. So that's why I like it. It's obviously ripping in my face at the moment today. You can see this big green candle. I don't like that. But we'll see. We'll see. We're sticking to our plan, but we're bearish Nike again. Find all those detailed trading plans on our website. Finally, AMD. I have not put a trade on an AMD yet, but I'm throwing this chart up here now because I will be putting a trade on In fact, I'm probably gonna do it right after I get off this show. So stay tuned for those of you at All Star Options. Stay tuned for details on AMD. That trade is forthcoming. So get after it. All right, everybody. That's all I have for you. As always, I want to just throw this slide up here with the updated stops. I know some of you like to have this this visual here. So if you need to pause the video and take a screenshot, do it now. But these are the 3 stops we updated: Tesla, Ego, and FXI. If you guys have any questions about what we've discussed today, shoot us an email, info@allstarcharts.com. You can follow me on Twitter. I'm @OptionsSean. Happy to engage with you there as well. All right, folks, have a great rest of your trading week. Enjoy your weekend. Summer's here. Make the most of it. I'll talk to you again next week. Until then, take care. Bye-bye. Thank you.